Hello, today's September 7th, 2023. I'm Russell Rogers from the Rogers team from Keller Southlake. Doug couldn't be joining us today, but we have a special guest, Craig Rhodes from Lending Edge Mortgage, and I'm so happy he's here and he has a lot of good information. So Craig, I'd like to throw it over to you to tell us about yourself.
I've been in business now for 27 years, Lending Edge Mortgage. We're out of North Richland Hills. Our parent company, AMCAP, is out of Houston, so everything we do is local, in-house in the state of Texas.
Yeah, that's awesome. And just so people know, we have no monetary exchange between the two of us, but I have used Craig, I think, 4 houses and then wouldn't refi.
Yes.
So 5 times personally. That's actually all the transactions I've ever done. We've used you, and it's gone well, obviously well enough to have him here. So Craig, we talked a little before we started, but I think the big thing right now is for first-time home buyers with affordability at kind of all-time lows, what are some programs that first-time home buyers or just other people can be using right now, and some misconceptions that you see?
So, a lot of times folks get the impression or their thought from watching things on social media that you need to have 20% down to purchase a house. That's just not the case. Right now you can do FHA loan is 3.5% down. There's conventional programs where you can put 3% down. Obviously, there are other options, USDA and VA. VA has zero down. USDA also has a zero down program. So buyers have a lot of opportunities right now. There are also grant options that are available through the state of Texas. Those programs are income restrictive. So you end up, as long as you qualify based off your income, then there are options to get anywhere from 3 to 4 to even 5% grant money, which would cover your down payment and part of your closing cost. So really, there are lots and lots of options to get folks in for 3.5 to 3% down to even less.
Yeah, I think that's a big one, right? Everyone thinks it's 20% down. Now your payment would be lower if you put more down because you'll have less interest and all those kind of things. But putting less down and maybe pocketing that for emergencies or other things might be a good idea. It's going to be based on what you want to do. Obviously, we're not your financial advisors. Speak to a professional. But I think that is a good one to clear up. So thank you for that. And there's kind of a caveat too, right? Where you really, that's the start of the conversation. They really need to reach out to you as the lender to get the specifics, right?
Yeah, that is true, because a lot of times you can get online and look up. The biggest problem we see is I'll have folks will call me up and go, okay, I want to purchase a $350,000 house and the payment's going to be $1,200. Well, they've been on a site. It's showing them maybe just principal and interest. They're not factoring in the mortgage insurance that you would have, the taxes, and the homeowner's insurance. So there's steps that you do need to go through to get, when you get pre-qualified, to know exactly your starting point. Do you need to be looking at a $350,000 house? Can you go higher than that? What is your true out-of-pocket expense if you maybe can't negotiate the seller to pay any closing costs? Right now, there is a chance that you might be able to get, based off how our market is operating right now, that you could get the seller to pay a little bit. But as things heat up, that would probably not be the case anymore. So right now, it's really important to check that stuff out, get pre-qualified, know exactly what your out-of-pocket expense, and make sure that payment is comfortable for your budget.
Yeah, and to get into that whole process, you have a very easy online application, correct?
Correct, yeah. Most of the time when I talk to people for the first time, I'll either text to whatever works best for them. I can text it to them or email it to them. All they have to do is click on Apply Now, fill out the application. It's a secured site. Then they can upload all their documents to that secured site. It comes straight to us. We get everything set up, and we'll get things moving that same day. The one thing that we do that's kind of unique is we take it a step further. A lot of companies will just pre-qualify you, pull your credit, verbally take your information over the phone as far as your income and your assets. We're actually going to take it a step further. We're going to ask folks to go ahead and upload stuff so we can take a look at everything, especially if they're self-employed, bonus income, commissions. We want to look at everything so when I issue like a pre-qual letter to Russell, it's not we think it's going to work, it will work. We're going to go ahead and get the loan fully credit income approved, which actually will help during the negotiation process. Because right now, listing agents are going to call. They're going to want to know, they're going to want to talk to that lender to make sure that everything looks good. Well, when they do call, what we do is I'll be able to tell them they're already through underwriting. I have them credit income approved. All we need is the appraisal and title work.
Yeah, and I always appreciate that too when it's a lender like yourself, especially you, but a lender like yourself where I can actually get them on the phone, where there's some big box lenders, which I won't name, of course, but you can't get them on the phone. Real quick story. Had a listing in 2022 where it was one of the big box lenders, but one of the smaller ones that I actually have a bank account with. And I didn't know they really had a mortgage arm, but it turned out the person I was working with from that company wasn't even with the company anymore. They had actually turned over and was doing some kind of transfer to the next person. Oh. And 4 weeks later, they tell us, I haven't worked there in a while, but talk to this person. And we were already past closing. So it was quite the issue. So I always like to work with you and other high quality lenders that aren't those big box guys, just, to put that out there.
Well, and like a lot of the agents I work with will say is, hey, if Craig's local, if need be, we can go to his office, we can stand there and we can talk to him, make sure everything's going well. It's not a mystery phone call going to another state that you can't go find the person that you're talking to. So that's one thing. We are in North Richland Hills, so I'm able to help you.
Yeah, definitely. You've even done stuff, I think, at Aggie games for me. Where yeah. You were like, let me just send this email real quick. And I'm like, no, wait till the game's over. But I know you have done stuff at football games for me.
Yes, if it's I do try to help make sure everything goes smooth.
Yeah, so I do appreciate that. And my clients do too. Well, let's talk about clients right now. So I was interested in specifically me, buyer profiles. What does the dynamic look like now versus what it's looked like the last several years?
So that's interesting because since pre-COVID 2019 and through COVID, really the contracts that we're going through, there were so many offers on homes. I think y'all discussed on a previous episode that, you had some homes that 26, 27 offers would come through. Right now, we're not seeing that many offers on homes, which is really a great thing, because what it's opening the door to, or at least a lot at the beginning of this year, what we were seeing is a lot more government loans, FHA and VA buyers getting their offers accepted. 2019, 20, and 21, it was such a frenzy that it was cash buyers or conventional loans with people putting a very large sum of money down. So it squeezed out some of our first-time home buyers, 3% down, 3.5% down, and especially our VA or veterans. Right now, this year alone, we've probably at our office closed more VA loans in 2023 than we probably closed in 2020 and 2021 combined. So offers are getting accepted. They don't have to be all cash deals right now, which is good. So the buyer profile, we're getting a better variety of different opportunities for folks. First-time home buyers, lower down payment folks. More people are getting opportunities to purchase.
Yeah, and that's great. I had so many during that COVID time period that just couldn't get under contract. Yeah. I mean, just in general, people couldn't get under contract. Yeah. But on top of that, if you had a government loan, it was almost like you weren't even looked at.
Yeah, and that was sad.
Yeah, I had one client. They luckily we were doing a lot of pre-market. I don't know the exact terminology, but before it went on the MLS, like trying to sell off market within the brokerage. And luckily with Keller Southlake, we're so big, there's a lot of opportunities. And I was able to find my clients like a $500,000 house that they bought with a VA loan in 2022, which was essentially unheard of. Yeah, I don't think if anyone will ever know about how good I did on that, but I'm going to tell y'all right now. But that was like really the only one that I saw go through. It's because it was off market. If you were competing on market, it was impossible.
Yeah, and it was just a rough time.
Yeah, and so I am happy to hear that. Obviously, being a veteran, working with VA loans, which Craig has done two of mine, by the way. We're happy to see that people can now participate again.
Yeah, that's good.
And not just the large investment companies.
Yes.
Well, no, that's good. That's great news. So let's talk about affordability a little bit. That's kind of the hot topic. There's definitely a tug of war going on with rates and prices right now. But, we talked a little bit before we started about what that looks like. And I think you have some slides that speak straight to it.
To your point, a lot of times when I'm talking to customers, they'll talk to me about waiting because they're waiting for home prices to come down. And that's not, I mean, we have no proof or facts that homes are going to always appreciate like they've been appreciating. But from the chart that's on the screen now, you can look at this. This is basically showing market appreciation since 1942 on home values. And what's interesting is it's basically the title's betting on the champ. 73 years, you had positive appreciation. 7 years, you had negative appreciation, and 1 was flat. So, everybody wants to look at the prices up in 2020, between 2020 and 2021, that how much we've appreciated over those last few years. But if you go back in history, from 1943 to 1947, prices were up compounded 118% during that time frame. If you thought the market was going to go down after that, you would have waited 43 years, 43 straight years of positive appreciation. Then from 74 to 79, we had 93% appreciation. And then that was up for another 10 years until 1990. It was just down 1%. I think that was 1% during the Gulf War is when that started. So that might have had an impact on that. Then we went 14 more consecutive years of positive appreciation. The X factor is always, everybody wants to focus in on 2007, 2011. Well, there's a lot of stuff that caused that. The demographics, we had less potential first-time home buyers. The median income for a first-time home buyer is 33. If you go back in history, 1972, that was one of the lower birth rates in the United States. So we had less 33-year-old home buyers at that point. So that was demographics. Inventory, we had over 4 million homes available at that point in time, where we have less than 1 million homes available right now. And poor lending. So very poor lending. Back then, the term was if you could fog a mirror, you could get a home loan. Lending practices have totally changed since then. Everything's been corrected since that time frame. And what caused that to happen was multiple factors that home values went down. It was really just a supply and demand issue. Right now, values have continued to appreciate because of the low supply of homes. So again, there's no guarantee that homes are always going to continue to appreciate in a positive fashion like they've been doing. But statistically speaking, or historically speaking, if you look at the data, it sure appears that it would continue on the trend that it's been going.
Yeah, and these aren't your words, or maybe even mine, but I think one of the closest correlations with government spending has been home appreciation.
Yes.
I don't have a data point to show that, but it'd be hard to argue the last several years that hasn't been part of it. And I don't think many of us would debate that the federal budget's going to really change from being, negative year over year, or the budget's going to continue to grow. So, and just to throw in another piece of mine, and again, we're not saying which direction it's going to go. We're just looking at the history here and trying to just give information. But for me, with our investment properties, we did have opportunities to sell in kind of like the mania timeframe, and we kept all of them. Now, we didn't add to our portfolio. Of course, we're in a different position if you're looking to buy a home to live in versus an investment. It's a totally different situation. But just a reminder, I didn't sell at that time. I may be right or wrong. We'll see. But I just want to put my cards on the table as well. Yeah, and so what we've also seen in our market locally, and I live in the Alliance area, and I think it proves out, is kind of at that May to June timeframe of last year in 2022. That was kind of the peak market or end of the mania. And we saw a decline of about 10% down from there. And we're about there, but we've clawed some of it back depending on the neighborhood and the house. And so we didn't really lose 10%. That was just 10% from the peak. So we really haven't even gone down year over year. And I think you have the data to show that.
Yeah, so on home prices turning higher, this chart it's based off 2023, and in January that was kind of a pivotal point where values were going still either flat or going down. What you're looking at is Case-Shiller, FHFA, CoreLogic, Black Knight, and Zillow, the top 5 that really track appreciation in the United States on homes. And the chart is nationally. It's not just North Texas or local, but this is national data. And really, as the months have gone on, February, March, April, May, and June, you've seen consistently month over month appreciation. And in the ones with FHFA, which FHFA, those are data points for homes with mortgages. So the other ones may not. There could be cash buyers. So the appreciation could have been different because it might have been an offer that someone couldn't refuse because it was a cash deal. But on the FHFA, those are all mortgage-related homes that they did the data points on. And you can see from February, anything in yellow were record-setting months. So as we're tracking 2023, if things continue at the pace that we're going, we could see anywhere from 5 to 10% appreciation in 2023, which would be a very hot year again.
Yeah, so We essentially went up from last year, which was up from the year before, and then even from that peak down was not a total negative.
Yes.
We've clawed some of that back, so it's all going to show a positive, and that kind of gets messed up with the way the month ended in May versus the year. But it does show, like, even with everything that's happening, it's almost impossible to guess where we're going. And that's why you really shouldn't just, listen to all the CNBC talking heads, because no one knows for sure. And I think the main thing, which we'll get into, is knowing the scenarios and understanding what it means for you and buying the house for you and your situation. And we had some talk before the show started about marry the house, date the rate. And I think I really want to caveat, and this isn't against lenders, this is more about realtors, because like we talked about, they always say it's the time to buy, the time to sell. They never tell you the opposite, right? Oh, it's a terrible buy or sell. But I think there's a caveat. That's good old wisdom. There's a saying for a reason, but the caveat is be prepared for the different scenarios. Like if house prices go down, what does that look like for you? Don't buy at the very top that you might be able to afford with no money down, with no money in the bank, and your job is in an industry that might get affected, right? If you are both lawyers for the government, that might be different than if you're both in a services job that might get greatly affected, however that looks for you. And so, Craig, what are your thoughts on marry the house, date the rate?
Well, so it is a term that lenders do use. And from the data that we look at, or that we, in a positive way, we want to see happen too, because it's good. It would be good for the industry and good for everything else. As inflation comes down, mortgage rates should follow. Historically, they always have. There's never been a time when inflation goes up, rates go up. Inflation comes down, rates come down. Inflation has come down this year. So rates should be coming down. Now, the term should is the asterisk point. Are we going to see rates come down in the next 6 months, 9 months, 12 months, or longer? It could take longer than that. I would love to see it in the next 12 months. Again, I'm a mortgage lender. I would love to see rates come down. I think it would help a lot for affordability on home purchase prices. If that does take place and rates come down, the 2 points that would be important is rates come down, the house appreciation stays consistent or not, or doesn't dramatically change. So if it went to 3% appreciation, we're still good. If it went anywhere, if it changed too much and the market dropped off, well, that could have a negative impact on folks being able to refinance, because you still have to have a certain loan to value in the future on that house. So to your point, Russell had mentioned earlier, well, what if they bought a house for $400,000, they put 3% down, and house values went down? Well, then at the point, if they wanted to refinance and say rates did go down to a number, say they did go down to the mid fives, hypothetically, then they could get that rate, but they would need to bring money to closing. If homes continue to appreciate and interest rates go down, there may be, most of the time, you have an opportunity to be able to refinance and not come out of pocket with any money. Again, at that point in time in the future is something I would be able to look at the numbers, take a look at what you owe on the house, see where we are on the value, see how much money you would save per month. The key thing on a refinance, and lenders, kind of like you're saying, realtors, that they don't ever want to tell you when it's a bad time to buy. Most mortgage companies will never tell you don't do a refinance. If we run the numbers and it does not make sense, or you're planning on selling in the house in the next year or two, it won't make sense. So it's important to talk to someone you trust. I would love to help you at that point if you would want to talk to me. And let someone run the numbers just to see, does it truly make sense? And are you planning on staying in the house for a duration that you recoup the cost that you incurred to do the refinance? If the answer is yes, then a refinance may make sense.
Yeah, we've actually had that conversation. I don't know if you remember, we have a lot of clients, but when I did my refinance, you ran it, and I think it was like 24 months was the payback time period for the closing costs. And so the question is, like you just said, are you going to be there for 24 months? What's your plan? It's like, yes, and then I'll save X amount every year after that. Yep. And so we did it, and we're still there, and we're saving that amount of money. So, but I think, though, to wrap up that whole concept of marry the house, date the rate, is take a snapshot now if you're thinking about buying a house, and it needs to make sense now, not for some future situation where house prices are, where you're just counting on house prices going up and rates going down, because it may not happen, and you don't want to be underwater in your house or buy too much. You just want to make sure it makes sense now, and then in the future it may even get better. So that's, I think, the point.
Agreed. Yeah, because if you're comfortable with the payment as it sits today, then, and if rates do improve, well, it's just gravy. Then it's great. Hey, your payment went down. That's perfect. But as long as you are comfortable with the house payment today, if rates never changed and they stayed exactly the same, then you're still good. And that would be your key point when purchasing a house.
Yeah, and Craig, tell us a little about with student loans coming back around. What's the impact there?
Well, so on student loans, even when they were during COVID, the relief that was going on there, and if you have a student loan that's in deferment or you're not making payments on it right now, even when it does kick in, we've always counted a certain percentage of the balance against the borrower in their debt to income ratio anyways. So just because you have student loan debt, just because maybe yours is in deferment, it's income based repayment, doesn't mean you're not going to be able to qualify. What we do is there's a percentage we're going to count against you in your debt to income ratio, and normally it's just not an issue. So don't let that be a deterrent on not wanting to purchase a house or move forward just because you may have student loan debt right now.
Yeah, and that's good to hear because there's a lot of things, even like the 20% down, a lot of misconceptions about how to buy a house that hopefully this has cleared up.
Yeah. One thing I was going to add to that real quick is credit scores. Credit scores are always, I'll have folks call me all the time. They feel like they've been told you have to have a 720 or 740 credit score to purchase a house. That is farthest from the truth. FHA, VA, you can go down below. You can actually, we did a loan recently, FHA loan. They did put 10% down the credit score. They had a 540 credit score. That's an exception, not the rule. Typically, if you have credit scores in the 580 to 620 to 640 range, we can we can look at it, figure out the details. You can go FHA or VA. Typically on a conventional loan, 620 is kind of that magic low number. Once you get below 620 on a conventional, you do tend to run into problems. The one good thing that we do, and I can't remember if we've been able to help any of our clients together, is there's a lot of stuff that we'll help folks with to help them get their credit scores up. Say you have a few little bumps and bruises on your credit scores, we'll walk you through the process. We can help you with getting goodwill deletions in some cases, which can dramatically change your credit scores. There's little tricks that you can do, not credit repair stuff, not paying people money to fix it, just little tricks that we know that you can do to your credit scores or credit report. And I've had folks' credit scores jump up 40, 50, 60 points in a very short amount of time.
Yeah, that was actually one of my clients. We won't name them, obviously, but they needed a little bit of help in that direction. And within like 30 days, they were up like 40 points or something. I don't want to oversell it, but it was some dramatic difference.
And it's not every time, but if there are times when we're able to do things like that, and that's a big difference. One, maybe getting approved or not approved. Two, a big difference in your interest rate. So those are things that make a big swing, and those are things that we're going to be happy to help you with.
And that's something you do for free, correct?
Yeah, absolutely.
Yeah, so that's just an added service they do to basically help you get that loan cleared or to get that lower interest rate. So I think that's a great deal.
Yep.
Okay, Craig, thanks for joining us today.
I appreciate it. Thanks for having me out. I enjoyed it. If anyone needs anything, get a hold of Russell, get a hold of me, and we can help you go through any questions that you have. I'd love to help you out.
Yeah, I'm going to put his website down below so you can click on that. I believe there's a big red apply now button.
Yes.
And then obviously there's contact information if you're not quite ready for that step. But either way, get in touch with him through those avenues and that'll work out well.
Sounds good.
All right. Thanks, everyone.